Our next guest says there are parts of the market that are relatively cheap right now, and that's usually a good place to look. Joining us now is Matt Miskin, co-chief investment strategist at John Hancock Investment Management. Interesting, Matt. I saw you heard the last discussion. You were standing. I thought you were our landlord here at the Glass. That's not. You were looking up. No, but
I'd like to be.
Actually. Yeah, you would like to be. But you have to work for a living. But you heard our conversation about onshoring.
Yes.
As a result, that goes into your thesis on why mid-caps are. How?
Yep. Mid-caps are trading about 13 times earnings, 30% discount to the S&P 500 overall. We've got this huge onshoring trend, and then this fiscal stimulus on top of that. So we're seeing this huge build-out in the Midwest, mid-caps, Midwest perhaps. But the industrial sector is the largest sector in there. And we're seeing these companies with 20% plus ROE trading at nice multiples, and they're seeing nice pipeline and demand to build out this manufacturing capability throughout the Midwest. That's one of our favorite parts of the market.
You kind of point out you're not saying, gosh, this deficit spending is great, but it is what it is. These deals are already signed. They're happening.
Right. And it's going to be coming the next several years, and that's where the money's going to be flowing. But there is wage growth. There is potential inflation. These companies have high operating leverage. They actually don't mind higher inflation. They tend to do better with higher inflation. So if you're going to look for something to hedge your portfolio for that, high-quality industrials to us in the Midwest are one of the best places to look.
Do you think we're at the ending stages of a cyclical recovery from the pandemic? We're in the end stages of that because of the Fed?
We've gone from the biggest easing in this country's history, the most fiscal stimulus, the biggest easing from the Fed, to the tightest policy we have seen in this country's history, the biggest whipsawing of policy in this country's history in 3-year window. It is tough because now we're at the tightening period. You got to look for things that are on sale already. You got to look for higher quality businesses with good balance sheets. That's, again, where we're finding that is that mid-cap kind of value spot.
So what you call it top-heavy, you mean like the Magnificent 7 or Magnificent 8, they're expensive? Is that your point?
That's the point. They basically haven't grown much other than NVIDIA in terms of earnings, but the multiples have jumped.
You went with NVIDIA instead of NVIDIA. We have this.
We go back. We do a tomato. NVIDIA. Is it NVIDIA? You said NVIDIA.
NVIDIA.
It's a N or an N.
That's what happens when you have some stupid consultant figure out your name, and then no one knows what the hell it is, like Venator.
I just follow the earnings revisions.
Venator.
See?
It's Venator. Trust me, that one I know.
I know. And Verizon.
Verizon.
Okay.
Emphasis on the wrong syllable.
On the wrong. I know. I do that from time to time. Your biggest worry? Well, you got two, and we all do, don't we? Interest rates and oil.
Yeah, right now those things are going to be fighting the consumer. Gas prices are coming up, higher borrowing costs by the day. Powell, in the press conference, wanted to see where restrictive rates would be. The bond market is going to tell them pretty soon. If rates keep backing up this fast, we're going to run into some problems. For us, again, within the equity side, we're underweight a lot of pockets of the equity market we think are expensive. We're trying to only allocate to those places that have already priced in a bit of this softness from tighter interest rates.
You know how great things were when we had low inflation and low interest. We had a strong economy and low inflation, and we wonder why financial assets did so well. That's the perfect elixir. What about slowing economy and high inflation? That's the death knell. That's the 70s and 80s. That's called stagflation, and financial assets don't go up. Is that possible? We're entering I don't know, not secular, but not some short-term period of that environment?
It's going to be tough to see this sustained. The Fed is going to be coming into this, and they're going to try to put it down. You know, I think they are going to be successful, but
really?
It's going to be painful.
Look at the onshoring. Look at the oil prices. There are a lot of underlying inflationary things that aren't supply chain or transitory. There are some. It seems like organic inflation is here to stay. No.
In our view, it's going to be more cyclical. Look, if we didn't do $5 trillion in stimulus, we wouldn't be having this conversation about inflation. That was probably once in a century type event, $5 trillion.
From the pandemic.
And really what we're seeing now, again, the Fed is raising rates, and eventually we think that's going to slow down the economy. It's going to slow down inflation. It's unfortunate that we're in this position, as you're saying, but we do think it's cyclical. We come out of this, we think, with a lower inflationary regime over time. But for now, yeah, it's going to create some volatility.